Okay, so section 3 is on high risk choices. We went over low risk and medium risk investing choices already. Okay, so the first investment option is a futures contract. What a futures contract is an obligation to buy or sell stock or a specific commodity for a set price on a set date in the future. They are used to hedge or reduce risk. And a commodity is an item that has the same value across the market with little or no difference in quality among producers. All right, so we're gonna watch this short clip.
Oh, William, my boy, right on time. Come in, come in. Sit down.
No thanks, guys. I already had breakfast this morning.
This is not a meal, Valentine. We are here to try to explain to you what it is we do. We are commodities brokers. Now, what are commodities? Commodities are agricultural products like coffee, which you have for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich. But then there are other commodities like frozen orange juice and gold. So, of course, gold doesn't grow on trees like oranges. Clear? Yeah. Good, William. Now, some of our clients are speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. If they place their orders with us, and we buy or sell their gold for them. Tell them the good part. The good part, William, is that no matter whether our clients make money or lose money, you can duke that the commission. Well, what do you think, Valentine?
Sounds to me like you guys a couple of cookies.
I told you he'd understand.
Okay, yeah, so commodities, again, those are items with little or no difference in quality among producers, like the example is shown there. Farming products are often commodities. So a futures contract is you sign a contract basically saying, on this date, I will buy this much of this for this much money. So for example, it could be in 1 year from today, I will buy this much wheat for $20 each, whatever the units are. And it's a high risk investment because you don't know what the cost of wheat is going to be in a year. Maybe it's higher. If the cost is higher and you agreed to $20 and now it's $40, you're getting a great deal. But if it drops down to $10 and you agreed to pay $20, then you're losing money up front. There's also options. So it's the right, but not the obligation to buy or sell a stock or a commodity for a set price within a set time period. So it's like a futures contract. The price is set, but it's a time period. So within a year, you have the option to buy this much wheat at this price. You don't have to, but you can. There's also the call option, which is the right to buy shares of a certain price before expiration date, and the put option, which is the right to sell those shares before the expiration date. So an investor who thinks the price of the stock or commodity will increase during a short period of time, they may decide to purchase a call option. And vice versa, On the other hand, though, if they think it's going to fall, the price will fall, then they want the put option. They want to sell before it, because at that set price, because it'll be lower after the expiration date of that contract. Other high-risk investments include collectibles, which are physical assets that appreciate in value over time because they are rare or desired by many. Examples include fine art, coins, baseball cards. Some cars are considered to be collectibles. So collectibles are very high risk because you don't know what the value will be, if it's going to hold its value in the future. Precious metals are rare metals that have known value around the world. For example, gold, silver, and platinum. But their prices can vary a lot over time. And then gems are natural precious stones, for example, diamonds, rubies, sapphires, and emeralds, which their price are often subject to change. So they have their highest value gems when they're in jewelry, but if you buy jewelry at retail prices, that has huge markups. Keep that in mind too. So if you go buy this ring with a ruby in it or a diamond, that's not necessarily how much it's worth because of the markup for selling it. So again, these are all high risk options. You can also invest in business ownership. So that is a high risk option. So there's a few different ways to invest in business ownership. The first is starting a business, which is very risky because half of small businesses fail each year, but it can also be very rewarding because both personally and financially, you can do something you love and you have the option to, the possibility, I should say, to make money off of it. And you can also take your company public through an IPO, which is an initial public offering. What that means is you sell some of your ownership to the public, basically like a stock, to raise money to continue to grow the company. So I believe that yesterday, DoorDash had its IPO, their initial public offering. So whoever owned the company, they decided to take it public. And so people could then buy shares of DoorDash yesterday. Airbnb also just launched their IPO. We'll look more into IPOs next chapter when we talk about buying and selling securities. But I saw the news headline about DoorDash yesterday and it jumped out at me. So you could start a business or you can buy a business outright or buy a franchise. So buying a business outright is one that's already going. A franchise, so is a contract that gives you the right to sell a company's products and services. It could be a little bit less risky due to having established products and services and support from the parent company. So the top 50 franchises in the world here. I was surprised. And this is old. This is, I guess I should have looked for a new link. I apologize. I didn't even think about it. But it just gives you an idea. So this is 5 years old. And it said that the top franchise was Anytime Fitness. 7-Eleven was there. Subway. Again, it's a little outdated, but I'm sure some of these top ones are still the same. So McDonald's back in 2015, the cost to open a franchise was between $1 million and $2.3 million. So to be able to own a McDonald's, KFC is pricey. Subway is much more affordable. It's between $116,000 and $263,000. So again, it's buying rights to have that name and to run a business how they do, to run a McDonald's, to run a Subway, to run a 7-Eleven. And again, it's a little less risky because those tend to be more well-known. And so people already know what's there, and like to support those places. The other option is forming a business venture, which is a new business or business idea that is backed by investors. But those investors, however, are going to expect a return on their investment. It could be to patent a new product, and then you could either bring it to the market yourself or sell it to another business to be developed further and marketed. Some affluent individuals use their own money to help small businesses get started. So you may, instead of investor, you may have an individual that's able to help you, or you can seek backing from well-known firms and investors. One second. Yes, Forrest. Sorry. Okay. And then the other option there are investors who may want to own part of the company and help run the company, or they could choose to remain silent partners who share profits of the return on the investment, but they're not liable for the business's losses and liabilities. So they just give you their money to invest or run your business, and they're silent about it, but they expect their return still. And then the other option is real estate. So we talked on Tuesday about real estate being, if it's the home you live in, your personal residence, that's not a high risk investment. But investing in real estate otherwise is. So there's direct investing. So the investor holds the legal title to a property and has control over management decisions. You could buy vacant lots or land. Those are considered speculative investments because you're hoping that that area is going to be developed and then the value will go up. And then rental properties, places you buy and rent out. It could be a vacation property. It could be an apartment complex. And then there's also indirect investing, which investors have a third person do the actual buying and selling of property. The trustee just is the person who holds the title. So there's real estate investment trust, which is like a mutual fund. It allows you to invest in portfolios of properties by buying shares. So what it is, it's a corporation that puts money in of a lot of individuals to invest in real estate projects. So maybe they buy an apartment complex that they run and operate. The real estate investment trust, though, you can buy and sell your shares freely, which makes it one of the more liquid options in real estate. And then a real estate syndicate is a group of investors who pool their money to purchase, operate, and then resell a single high-priced property. So it's just a temporary thing because their goal is to resell it for a profit.